To make these wonderful financial statements, we need bookkeeping entries. So, and there's a difference between bookkeeping and accounting. Bookkeeping is recording the transactions, and it's the fundamental record keeping. Accounting is really making decisions about how things should be measured, how they should be presented, depicted in the financial statements, what types of disclosures should accompany those financial statements. It's a much broader, more valuable practice. But at the end of the day, in order to accumulate the information so that we can report it to users, we need to go through a bookkeeping process. Now, this is not a course in bookkeeping, but you need to at least be aware of some of the fundamentals. And we get to this fundamental accounting equation. Assets equal liabilities plus owner's equity. In the realm of a corporation, as a reminder, it would be stockholders' equity, or it could be members' equity if it's an LLC or whatnot. But what we're seeing here is the balance sheet in the form of an equation. When we looked at the balance sheet, total assets equaled the total of liabilities and stockholders' equity a few minutes ago. Now, as we expand this accounting equation, what you can see is when our company generates a profit via net income through the income statement, that's where it's reported, owner's equity increases. And then when we make distributions to our owners, if it's a corporation, it'd be called a dividend. Different forms of business would have a different terminology, but the concept is the same. If we give owners a return on their investment, then that reduces owner's equity. Now, we can't completely escape debits and credits here. Let's talk about this for a second here. We have the 5 basic categories of accounts that can be used to keep track of a business's activities. And I don't care if you're as big as Facebook or Amazon or, Ford Motor Company, huge organization, or if you're as small as like the local coffee house or local plumbing shop, you would have these 5 basic building blocks. Now, of course, Ford Motor Company is going to have a whole lot more asset, liabilities, revenues, all individual accounts that they would use compared with maybe a small local business. But they're still going to have the 5 basic building blocks. Okay? What you own, what you owe, the owner's claims to the assets of the business, revenues coming in from customers, and expenses. We need those in order to generate the revenues. And we do this with something called double entry bookkeeping. What that basically means is that every transaction that needs to be recorded for the business is going to affect at least 2 accounts. And we're going to use debit and credit rules to determine whether an asset, liability, equity, revenue, expense, whether it goes up or down. Now, sometimes people, they think about debits and credits in terms of the cards in their wallet or their purse. Debit card, credit card. And you really need to break yourself of those preconceived notions, because debit does not necessarily mean increase or decrease. And credit doesn't mean increase or decrease. What it really just means is making an entry on the left side or the right side of an account. A lot of times we'll use something called a T account to depict this activity. So let me pick the most basic asset, cash. Okay. If you need the cash account to increase, then you're going to make a debit entry to that account. You're going to make an entry to the left side of that account. And if you need the cash account to decrease, you're going to make an entry to the right side of the account, which would be a credit entry. Now, let's pick a liability. Accounts payable. This measures what we owe to our vendors. We purchased something, we did not yet pay for it. This is going to be exactly the opposite. If you want accounts payable to go up, you make a credit entry. It's the opposite of cash. And if you want it to go down, you make a debit entry. So we're starting to see these debit and credit rules. The easiest way to remember it is to kind of just memorize what happens to cash. and you know that cash is an asset. If you can memorize what happens to cash, you can take these rules and you can apply them to any other one of these categories, and we'll see that in just a second. The easiest way that I know to remember the debit and credit rules is this. Memorize what happens to cash. Cash gets increased with a debit entry to the account. And once you know the rule for cash, you actually know the rule for all assets. The same will be true for inventory and accounts receivable and prepaid expenses. All these various assets, they all increase with a debit entry to the account. And if a debit entry makes an account go up, a credit entry will make the account go down. So if you know what happens to assets, then you can come down here and you can remember that expenses behave the exact same manner and everything else is the opposite. So liabilities, owner's equity, and revenues, they decrease when you make a debit entry, and they increase when you make a credit entry. So memorize what happens to cash. That will let you remember what to do for any asset account. Then just understand that expenses behave the same, and liabilities, owner's equity, and revenue accounts, they are exactly the opposite of assets and expenses. That's the easiest way that I can think to have you remember the debit and credit rules. And so to just give you one example, let's say that we have our cash account right here, and let's say that we're going to pay for some insurance coverage, insurance expense right here. So let's think about what's happening. We're making a payment to our insurance company. So cash is going to decrease, and I'm just going to make up a dollar amount. Let's say it's a $1,000 payment for the current month. So cash decreases. We made a credit entry to the right side of cash right here. And what's going to happen is insurance expense is going to increase. Insurance is an expense. And we can see that making a debit entry to that account causes it to increase. Okay? What if it wasn't a payment for insurance expense? What if it was a payment for some inventory, which is an asset? Look what would happen here. In this case, we would have one asset decreasing with a credit. We would have another asset increasing with a debit. So keep these rules in mind. If you want an account to increase, you need to know whether a debit will accomplish the job or a credit is needed. If you want that account to decrease, you need to know, is the credit what's going to happen, or do we need to debit that particular account to make it go down?